Hi, I'm Rod Brown, real estate broker at Fantastic Realty Inc., and I'm here to share a game-changing insight for real estate investors. If you're eyeing value-add multifamily or vacation rental deals, you need the right tools to evaluate them. Today, I'll explain in just 2 minutes why unlevered yield on cost, or UYOC, is the ideal valuation metric for these deals, and why it beats cap rate for unlocking their true potential. Whether you're new to investing or a seasoned pro, I'll break it down so you can make smarter decisions and maximize returns. Let's dive in. Value-add deals like upgrading a multifamily building or turning a property into a high-end Airbnb are all about boosting income through renovations, higher rents, or better operations. The problem? Traditional cap rate, which divides a property's net operating income or NOI by its purchase price, doesn't tell the full story. At acquisition, cap rate often looks low because the property's underperforming. Think outdated units or low rents. It's a static snapshot, great for stabilized properties, but weak for value-add deals where you're investing to transform the asset. Enter unlevered yield on cost, the metric top private equity firms and I rely on. UYOC measures the stabilized NOI after your renovations and improvements, divided by the total project cost, including acquisition and renovation expenses. It's forward-looking, capturing the cash flow you'll generate once the property's potential is unlocked. Unlike cap rate, which ignores the capital you'll spend on upgrades, UYOC accounts for every dollar invested, giving you a clear picture of your return on total capital. Let's make it simple with an example. Say you buy a $5 million multifamily property with a low initial NOI of $200,000, giving a cap rate of 4%. You invest $1 million in renovations, new kitchens, modern amenities to boost rents. Post-renovation, the NOI jumps to $400,000. UYOC divides that $400,000 by the total cost, $6 million, yielding a 6.67% return. That's the cash flow efficiency of your strategy. Cap rate at purchase doesn't reflect this. It's stuck at 4% and misses the renovation costs and NOI growth. YOC is unlevered, meaning it excludes debt, so you can compare deals fairly regardless of financing. It focuses purely on the property's operational performance, stabilized rents, and the costs to get there. But does it capture appreciation? No. YOC is a cash flow metric, not a total return metric. For appreciation, like a higher market value from your increased NOI, you need a 10-year discounted cash flow model, or DCF. A DCF projects cash flows, including tax benefits like depreciation and the exit value, capturing appreciation and giving you metrics like internal rate of return, or IRR. Together, UYOC and a 10-year DCF are the gold standard for value-add deals, used by every major private equity shop. Why a 10-year DCF? It models annual depreciation, say $128,000 yearly for a $5 million multifamily's depreciable basis over 39 years, lowering your taxes. It also captures accelerated deductions from renovations, like 5-year depreciation on new fixtures, boosting early cash flows. Plus, it projects NOI growth and a sale price, reflecting appreciation from your value-add work. A shorter model misses these benefits. A longer one gets speculative. UYOC tells you the cash flow return. DCF shows the full picture, including tax savings and exit gains. As your broker at Fantastic Realty Inc., I use UYOC and 10-year DCFs to evaluate multifamily and vacation rental deals, ensuring you invest wisely in high-potential properties. Ready to dive into value-add investing with confidence? Contact me for a free consultation. Like, comment, subscribe, and let's unlock the power of UYOC together.